With more Western countries raising taxes, threatening to raise taxes, and threatening to impose entirely new kinds of taxes, more people than ever are looking to escape their country's tax system, and today I'm going to tell you how to do that. I'm Andrew Henderson. This is Nomad Capitalist, where we've helped everyone from multiple billionaires and celebrities to close to 1,000 everyday 7- and 8-figure entrepreneurs and investors like you who want to legally go where you're treated best. And today I'm going to talk about how to escape your country's tax system. And the first place I want to start to get us there is an explanation of the different tax systems that you may be living in so that you know where you're starting from and you understand some of the most common misconceptions, because I think there are a lot of them out there. I'm going to address this primarily to folks who were born in one country, they're a citizen of that country, and they are both a physical resident and a tax resident of that country. There may be some exceptions if you are temporarily living in a high tax country and you want to get out. That may be a little bit different in some cases, but I'm focusing on people who have spent their entire life in one country and now want to go where they're treated best. So let's go through the different types of tax systems. The most aggressive is citizenship-based taxation. I've said that I believe a couple more Western countries might move towards this in the future, but right now it is primarily the United States. You've got Eritrea and Africa that has its sort of diaspora tax. Met taxi drivers in San Diego from Eritrea. They've never heard of this thing, so effectively it is the United States. Other countries have had some version of it in the past, but the U.S., no matter where you live, will tax you, and it will continue to require you to report your foreign bank accounts, your foreign corporations. You're subject to all the regulations of the U.S. So basically, U.S. citizenship is not just about taxes, it's about reporting, it's about regulation, no matter where you live. Now, you can move to Puerto Rico, and you can take advantage of lower capital gains and income tax rates there. That solves the problem within a U.S. territory. You can also move offshore and, depending on your situation, reduce your tax rate potentially to as low as zero. At the worst case, to the single digits or the low double digits, depending on your business situation. So if you're sitting in the U.S. paying 40% tax, understand that there are still exceptions, exemptions, exclusions that you can use to dramatically reduce that tax rate, whether it's moving overseas with your business, whether it's moving to Puerto Rico. There are ways to reduce it, but you are still subject to requirements. You can't simply say, I'm escaping the tax net of the U.S. for good, because even if you live overseas and your tax rate is legally zero, then you still have to say, hey, I have this bank account. You've got to report that back to the U.S. Treasury. So you're not totally free until you expatriate, until you renounce your citizenship. And so record numbers of people have been doing that in recent years. It's obviously a very extreme step that requires, among other things, a second passport and an entire plan of how you're going to do that. But that is, for Americans, the way to escape the system. Now, what if you're not an American? You're Canadian, you're European, Australian, etc. You live in a Western country, likely in a residential-based taxation system. People get this confused, and they call it sometimes citizenship-based taxation. So again, pretty much any EU country, pretty much any Western country. What happens is, if you live in that country for tax purposes, you will be taxed on a global basis. And so what people, a couple misconceptions, they'll think is, I'm Canadian, I'll go set up my company in the British Virgin Islands, and then I'll come back to Canada and run the company, but I'll go once a year to the British Virgin Islands for board meetings. Doesn't work that way. You're a tax resident of Canada. That means you pay tax on your personal income, but it also means that you're going to suck any kind of companies that you control or that you own into the nexus of Canada or whatever country we're talking about through all sorts of different kinds of rules. And so, if you want to escape the tax system, you can do that more easily than an American, but understand that everything you own worldwide will be taxed. And so, let's say you go to Georgia, for example, the country of Georgia, you make an investment in residential real estate, and then you rent that property out. You're going to pay 5% gross rental tax on that. That's great. It's like, hey, I'm only paying 5%, but if you're living in a country that's tax rates are higher than 5% on that kind of income, you may generally pay the difference on that where you live. And so that's because if you live in Canada, you can avail yourself of different credits and different exemptions again, but if you have income overseas, but you're going to be paying at Canadian rates. You're going to be paying at Australian rates, New Zealand rates, generally speaking. Now, obviously, sometimes the tax systems don't work out. That can work to your favor or that can work against you, as we often see with people who are in both the U.S. and Canada. The tax systems don't always match up, and it creates some really frustrating situations. People often renounce U.S. citizenship to live in Canada, not because they don't want to pay tax, but because the tax systems simply are too different. And so if you are, again, living in a Western country, those investments overseas, that interest on bank account overseas, that may be taxable in your own country. The difference is you can simply leave. And there are different countries There are different standards in terms of how easy it is to leave. I think the common misconception is just don't spend 183 days, commonly known as the days test. That's not really the case anymore, because pretty much any Western country with its salt is going to have numerous different rules in terms of, do you have a home? What are your other connections in the country? What's your family situation? There's all kinds of different primary and secondary ties. They go by different names in different countries, but all kinds of different things that tie you to a country beyond just a days test. And so people often, especially in the digital nomad world, they just leave the country and say, hey, I don't need to do anything. They just stop. They just go, radio silent. And then maybe 5 years from now, they get a letter in the mail, and maybe they're putting in peril those 5 years when they weren't paying taxes, but they never properly exited the system. And so it's not simply a matter of spending fewer than 183 days. Not every country, by the way, has that number. Some countries it's 120, some countries it's an average, a rolling average, some countries it's 180. So not every country has the 183. It could be different. It could be counted over 2 or 3 different years in some cases as well. But if you fulfill the criteria to get out, and this is something that we help people with our network of tax experts, if you get out, then you're out. And then you no longer have to, when you go and set up your new home in Dubai or the Cayman Islands, or whether you're kind of moving around the world. That can be increasingly dangerous for Westerners. But then you can have that flexibility. And so you can create your own flexibility, but it's going to be a process to get out. The countries in the Anglosphere, in my opinion, are a bit more difficult. They have more rigid rules in many cases than some countries in mainland Europe, right? If you're Austrian, if you're Polish, those countries, there's still some steps to take, and I see people who are doing it too liberally, in my opinion, but it's going to be a little bit more flexible from my experience than the countries like Canada, UK to a certain extent, Australia, New Zealand. Those are going to be more difficult. Okay. Now, in some cases, your country will say, hey, you can't move to a certain kind of country for the next 3 years or 5 years. So Mexico, for example, if you move to a tax haven, there has to be certain things in place, or else they're going to continue to tax you for up to 5 years. And so you want to find a country that is not on their list of tax havens, or that has the proper reciprocal agreements to make sure you're not going to continue to pay them for the next 5 years. Other countries, like in Northern Europe, sometimes have this, where you have to go to a certain kind of country for 3 years. French citizens, for example, for 60 some years haven't been allowed to move to Monaco. You can move to Monaco, but you're not going to get the tax incentives of Monaco. And so you can leave your country. There are a few exemptions like the ones that I mentioned. Colombian citizens living in Panama face some troubles. So most people aren't going to face that. Certainly, if you're US, Canadian, Australian, New Zealand, most European countries, you can just go to Dubai straight out. You can go to the Cayman straight out. You can go to a country that may not have a 0% tax rate, but effectively won't tax you, or a country that has a flat tax or lump sum tax. So there's lots of options for getting out, but if you are Western, not American, you can simply get out, but you've got to cut your ties. The next system is the Territorial Tax System. You'll see this in countries in Central America, Southeast Asia, a couple of countries in Eastern Europe, couple countries, spattered around. And so this is where basically the source of the income is territorial. Now, people again get this confused, right? Because they think, oh, if I'm not tax resident in Canada, I can continue to hold investments in Canada. Property that's held in Canada or a business incorporated in Canada will continue to be Canada source. And again, that applies to pretty much any country, right? So there's really no purpose. If you live in Dubai, you'd be pretty dumb to go and say, I'm setting up my company in Australia. I want to pay Australian corporate tax rates while living in Dubai. Dubai's not going to stop you because they're not going to add anything to that, but they're not going to stop you from paying Australia's tax rates for your corporation. So people think territorial tax, they think, my country's residential, so I've gotten out. No. If you continue to keep rental properties in a country, for example, you will continue to pay. In the same way that I've never been a tax resident of Canada, but if I buy rental property in Canada, the fact that I don't pay taxes on my worldwide income there don't mean I just get a free pass. Oh, I don't have to pay rental income tax. No, that's not how it works. It means I, as a tax non-resident of Canada, someone who does not pay taxes in Canada, only pays on the stuff that I have there. In some cases, like with a bank account, if you can earn interest in any kind of Western country banks these days, they'll have kind of an automatic withholdings tax because they figure, hey, this guy's never going to file a tax return for $200 in interest. We'll just deduct it at source. That will happen sometime. So never confuse a country like a Malaysia or a Panama that has a territorial system with a Western country that has a residential system by thinking that once you're out of a residential system tax net, or out of the U.S. tax net, that somehow you can just continue to invest there with impunity. The only real exemption is if you're a non-resident alien of the United States, your interest income from bank accounts is generally not taxed. There may be other considerations you want to think about for estate taxes there. But other than that, stuff may be taxed in Western countries. Now, let's talk about territorial tax. Territorial tax is where the income of the territory is taxed. Everything else isn't taxed. Now, sometimes there are exclusions. So, for example, you look at a country like Thailand, there's a remittance-based approach where if you earn money overseas, you're supposed to bring it in either in the next year, and there's certain different conditions on how you can bring that money into the country. Malaysia looked at a system like that, where if you were a tax resident and you brought in money, it may be taxed. They postponed that for the next 5 years, and so they're going to revisit that in about 5 years. Certainly, if you're running a business or if you're working more so for your own business in a territorial tax country, that could be taxable, right? And so there's different rules on, what is actually overseas income and what is domestic income. If you sit in the country 365 days a year and you are actively working in a business, that may not be deemed offshore income. But if you live in a country like Panama and you've got investments in Georgia, Panama is generally going to leave those alone. A territorial tax country would say, well, that's not income from our territory. We're going to leave that alone. In many cases, your company could be based somewhere else, and then you could live in a different place. So this is where you can see you want to kind of choose from the buffet. You want to find a place where you want to live that offers you tax incentives, but that may not be the best place to incorporate. You can incorporate your business in Labuan in Malaysia, but if you want to live in Malaysia, there are other ways to get a residence permit to Malaysia where you can put the business somewhere else and then coordinate appropriately. Same thing with Panama. You can get a Panama company, but it may not be the cleanest approach if you're going to live in Panama. So a territorial tax country is going to say income that's derived overseas. There are different definitions for that. It's not as clean cut as some people would like it to be, but if you properly analyze what income is actually offshore, they will leave that alone, and potentially you can pay zero, even though that country has a tax rate for domestic income. People who have a job, people who have rental income locally will pay tax, but offshore, you don't pay tax. That's not specifically targeted at foreigners, by the way, right? If you're a Malaysian citizen living in Malaysia and you have investments somewhere else, Malaysia generally, they won't look at that, right? That's not on our territory. Okay. Now you have separate systems, which we haven't talked about as much in the past, which are designed for foreigners. Take Italy, for example. There's a lump sum regime. If you have not been a taxpayer in Italy for the majority of the last 10 years, you can come and you can sign up for their lump sum regime. By the way, it's not always entirely for foreigners. In this case, an Italian who hasn't lived in Italy for a long time could come back. But it's people who haven't been taxpayers in the country. It could be lump sums, could be exceptional programs, it could be exemptions. There's many different ways, non-dom programs, where you can come and pay some kind of flat tax, pay on remittance, get an exception for 5 or 10 years. These are often, again, towards foreigners, right? If you've lived in London your whole life, it's hard to take advantage of the tax incentives that someone like myself could come and live in London and basically bring in what I need to live, but leave a good amount of money offshore. If you're from Uruguay, you can't just say, oh, you know what, I'm going to take advantage of this 10-year tax exemption. So you've got various programs where you might be able to pay zero. You might be able to pay only on your living expenses. You might be able to pay only on some version of your cost of living, like in Switzerland. You might be able to pay a flat amount, such as in Italy, 100,000 euros a year, 125 if you're married. Again, often targeted towards foreigners. And there's various versions of, is there a wealth tax? How long does it last? Is there a social tax? There's many different things that are involved here. These plans can allow you to get out of your country's tax debt and get into another one where, hey, the taxes may be relatively high in that country, but you're getting a carve out, you're getting an exemption, you're getting taxed on a greatly reduced amount of income, whatever the case may be. That's another system. And then lastly, you've just got countries that are totally tax-free. So you've got the UAE, you've got a lot of countries in the Middle East, you've got Cayman Islands and Vanuatu and all those tax-free countries. And so some people, they want to go and live in the Caymans or the UAE. Those are kind of some of the most popular ones. But you can see that when you open up the idea of there are countries in Europe that may not be tax-friendly for locals, but could be tax-friendly for you. Same thing with South America. There are countries like Central America and Eastern Europe and Southeast Asia where if you structure yourself properly, you don't have to pay much tax or any tax at all. You can see how you can get out of the tax net. But what you're also seeing is, number one, there's complication of these things. Number two, There's proper planning, especially if you're an entrepreneur, especially if you're an investor. Certain types of things. Look at Portugal's NHR program, for example. People think it's basically a tax-free program. It hardly is. You need to structure and classify all the different types of income that you have. Okay. And so how do you escape the tax net? You understand how these programs work. You understand if you're an American, you've got a couple of different options. And listen, those options could vary based on, are you married? Those options could be based on, what kind of a business do you run? Do you have business partners? I mean, there's all kinds of different questions that would come up for an American. If you're not, if you're not an American, you can simply get out of the tax system, but you've got to clean up some stuff. And then you've got to go to one of the countries that is territorial, has a tax incentive program, or has no tax. And so it's getting out of one country, it's getting into another, and it's doing the proper tax planning to make sure that you are properly out, that you are properly in, and that you're the new one, and that your income sources match up. And so, someone who can take advantage of tax incentives in the UK, for example, as an entrepreneur, may not be able to do so as a cryptocurrency investor. Right? Someone who's a cryptocurrency investor may have a better time going to Portugal than someone who's running a business making $10 million a year would be going to Portugal and structuring their affairs through the NHR program. So how do you escape your system is you have to analyze the impact. But getting out of your system means understanding what you're getting out of. It's not as simple as just packing your bags and leaving and coming back for 6 months. That's not going to work anymore. It does work in some countries. But if you're from the West, it's generally not going to work that way. It may not even work if you're there for 3 or 4 months a year in some cases. It really depends on how you set up your life. So this is why when you come and work with our team, we're going to probably ask you 200 to 300 questions about the entire situation. We're going to bring in multi-jurisdictional tax professionals, and we're going to diagnose everything of what you're doing. Because the situation, again, entrepreneurs, options traders, day traders, crypto investors, I mean, there's something for everyone. But you want to get out of one of the first 2 systems. You want to get into one of the second 3 systems. And that's how you can escape your country's tax net. Don't stop now. We've got well over 1,000 more videos here on YouTube for you to watch and learn how to go where you're treated best. And if you want to work with Nomad Capitalist personally, go to nomadcapitalist.com/apply, learn about our unique, tried and true process, garnered over years of experience, and learn how you can become our client.